Hi, everybody. This is Sara Shahram, Portfolio Manager at Empire Life Investments. I hope that all of you have been keeping safe during these truly unusual times. As you've been hearing from many of my colleagues, we've been trying to do our part to flatten the curve by continuing to work from home. So here I am at home, and I thought I'd take this opportunity to talk to you a little bit about the movement in the gold price. So we've seen gold go from about 1580 an ounce in the beginning of the year to about 1725 today. That's an increase of 14% at a time when the TSX and the S&P have been down 12.5% and 8.5% respectively. Today we're going to look at some of the factors that might explain the significant outperformance of gold. Gold is unique in that it has both commodity type as well as macro or currency type characteristics. We're going to touch a little bit on the commodity side, but we're going to focus mostly on the macro side, which tends to be a bigger driver of gold prices. So from a commodity side perspective, when looking at any consumable commodity, we look at factors that impact physical demand as well as physical supply in order to determine whether the commodity is going to be in a surplus or in a deficit at some point in the future. We do this in order to estimate the price of that commodity at that point in time. When it comes to gold, though, that analysis alone doesn't really help us in predicting the gold price. The reason for that is that investment is becoming a more significant component of demand. And investment is impacted by factors such as sentiment, as well as macro or economic concerns. The annual supply of gold is roughly 4,800 tons. That's about 150 million ounces. That supply consists of two primary sources. The first one being new mine supply, which is about 70 or 75%, and the remaining 25 to 30% is what we call recycled or scrap gold. From a demand perspective, the drivers are central bank buying, technology, jewelry, and investment. Investment includes both bar and coin as well as ETF buying. With technology being a fairly small percentage of demand and central bank buying having been a fairly consistent number over the last 10 years, although I should actually caveat that by saying we could see some changes in central bank behavior on the back of COVID-19 as some countries, especially the oil-producing countries, look to preserve some cash. But for the most part, that central bank buying has been fairly consistent. Jewelry and investment tend to react differently to gold prices. As gold prices go up, especially in local currencies, then jewelry becomes a lot more expensive, and we see that demand go down. However, the very factors that cause that gold price to go up very often increase investment demand for gold. Investment demand is driven by macro factors. During economic and political uncertainty, we seek the safe haven nature of gold. So we see investment demand go up. Uncertain economic times usually involves government interventions, either in the form of monetary or fiscal policy. And that usually involves interest rate cuts, as well as printing of more money, which causes the debt levels of these governments to go up. At extreme levels, these factors cause investors to lose confidence in fiat currencies, and they also become a lot more concerned about potential future inflation levels. All of these factors increase the attractiveness of gold, which is viewed to be a store of value. The other aspect of gold is that it doesn't pay a dividend or interest. So the lower the interest rate environment, the lower the opportunity cost of owning gold, the more attractive it becomes as an investment. I'm also going to touch very briefly on the relationship between US dollar and gold price, which has historically been an inverse one, meaning that as the US dollar weakened, the gold prices tend to do better. This relationship, however, has broken down over the last few years. The reason for that is on the back of flight to quality. So investors have been seeking relative safety, and that has meant demand for both gold and US dollars. Now let's take a look at where we are today. COVID-19 has resulted in unprecedented global move by central banks to essentially do whatever it takes to combat the negative impacts of this disease. The monetary and fiscal support offered by governments has resulted in many cases negative real rates and ballooning of already high levels of debt. As discussed before, both of these factors would reduce confidence in fiat currencies and really increase the store of value attractiveness of gold. Also, what we have been seeing is the negative interest rate along with high valuations of equity markets and a move by companies to cut dividends in an effort to preserve cash. All of that reduces the opportunity cost of gold, therefore making it even more attractive. So these factors have resulted in investment demand for gold being up. ETF levels are today at 99 million ounces, which is an all-time high. And gold prices have continued to go up despite a 40% year-over-year decline in jewelry demand in Q1. So today's environment seems to be very supportive of gold price, but there's one factor that adds another layer of a complexity in determining gold prices, and that is sentiment. More than any other commodity, gold tends to be impacted by investor sentiment. And this sentiment can turn fairly quickly, which can make the commodity price very volatile. As an example, if we hear tomorrow that the impact of COVID has been milder than what we have been expecting, then we could see a very sharp decline in gold prices. So we have been increasing our gold exposure in many of our funds over the past 6 months, really as a form of insurance against some of the negative factors we've discussed earlier. But even when it comes to gold investing, we stay true to our philosophy, and that is to own companies with competitive advantage and solid management teams with really good track records of capital allocation. One example is Agnico Eagle, which we own in many of our funds. The CEO has been at the helm since 1998, and Agnico has been one of the best and most consistent gold performing equities in the sector. The portfolio of Agnico is in very safe jurisdictions like Canada, Mexico, and Finland, and it has a very attractive cost structure as well. The management team has been very disciplined when it comes to capital allocation, both organically and inorganically. So this has resulted in Agnico having one of the better free cash flow and dividend profiles amongst its peers. We were able to add Agnico to many of the funds at very attractive valuations when a very uncharacteristic operational hiccup caused a big drop in the equity price. So we had many calls with management teams, and we gained confidence that they knew exactly what the issues are, and they have solid plans in place in order to address those issues. So that gave us comfort to go ahead and add the name to many of our portfolios. So that was a very brief discussion on gold. I want to thank you very much for your time. I hope you found this off the cuff informative. Until next time, please stay safe.